Hi everyone, welcome back to the channel. So can you actually retire in 10 years using real estate starting from zero? In this video, I'll be using the financial planning software I use with clients and modeling what happens when a couple starts with a $0 net worth and builds a rental portfolio from scratch. So without further ado, let's dig in. Here we are in Right Capital. So starting out, we have Chad and Stacy Smith. They're both 30 years old, no kids, and it's not that you can't retire early if you have kids, it just adds in another variable that I didn't want to include in this. Moving on over to the income tab, they're both making $100,000, so a combined income of $200,000, and they are increasing their salary by about 3%, so in line with inflation every year. Going to the expenses tab, we see that their pre-retirement living expenses are $4,000 a month. This does not include their rent, which we'll get to in a second. And then they are also married, filing joint, and they have a monthly health insurance expense of $1,000, which increases with health inflation, and it ends at age 65 when they become eligible for Medicare. Now, moving over to the net worth tab, we could see that they have literally nothing in assets. They've partied it up for their entire 20s, don't have anything saved, but they also don't have any debt. Now, looking at their current rent, they currently they're spending $2,000 a month in rent and then about $200 in renter's insurance. So the first thing they're gonna wanna do is stop paying rent to a landlord and instead move into a property where their tenants can pay down the mortgage for them. Now let's go to their goals. So as I said, they're 30 years old. Their goal is to retire at 40, and then in retirement, their expenses are going to remain about the same. The general rule of thumb is that your retirement expenses are 70 to 80% of your pre-retirement expenses, but I like to be conservative with these scenarios. So moving along, we're going to see that their first foray into real estate is going to be through a house hack, where they buy a multifamily property, move into one of the units, and then rent out the others. So with this, it's going to be a purchase price of $500,000. This is going to occur next year. And just looking at these numbers here, the way that I put together these numbers is that they're looking for about a 5% cash on cash return for their rental investments. So that's not like a home run kind of deal. It's just a base hit basically of a deal. Now for their first property, because it's owner occupied, they're going to go in at 10% down, 30-year mortgage, and the interest rate is at 6.5%. Now they are also going to be buying rentals only. So their rentals that they're going to be buying in the future, this is a scenario I put together, a $500,000 purchase price. Property taxes we have in here, annual insurance, maintenance, and then this is the monthly rents that they're going to be getting off of the properties. Now they're also going to be doing 20% down payment on these, so that way they don't have to pay the private mortgage insurance, commonly known as PMI. All right, so now that we got the ground rules down, let's see what this looks like from a cash flow perspective. So we're gonna go through a few years of their life and see if they have enough cash coming in to really cover all these goals. So starting out in 2026, we see here that they have a salary of $200K. Their net cash flow saved is about $65,000 for the year, and we also have their tax payments and their living expenses included in this. Now let's move to 2027. This is the year that they buy their house hack, and as we could see, they still have their salary that's bumping up with inflation, and this other income here is the rent from the second unit in their house. We're going to say that they are buying duplexes, so they moved into one unit and are renting out the other. Now moving along to 2028, they're buying another property this year. So continuing along, it looks like from here on out, they probably have enough cash, yep, another property, to buy every year here on out. And then, this year they are buying 2 properties. And finally, in the year of retirement, well, we can see that they're net negative almost 13 grand for this year. So they're gonna have to be living off of savings, and hopefully they start from the increases in rents, start making some more money. So let's skip forward a few years and see, yep, they start saving money. We'll skip forward even more. So now at age 50, we see they're saving about 70 grand in their cash flow. This is because as rents increase over time, they're gonna get more and more cash flow. Now what you see here is these numbers are starting to get pretty large, and that's just because of inflation. Over time, the dollar gets weaker and weaker, and so these numbers start getting pretty large, and we're projecting far out into the future. So like, let's look almost 70 years into the future. At this point, you can see, yeah, they have millions in inflows, and that's a large part of it is just due to inflation. Now, we also project out on these that in the last few years of someone's life, they tend to have more in medical expenses as well as assisted living expenses. So we see here that, yeah, they're net negative for the last few years. Let's go to age 100. Yeah, so they might be at risk of running out of money. So let's see what happens when we go to their net worth. These non-qualified assets here, these are their bank accounts. So we could see that their accounts kind of, for the first few years while they're working, bump up and down because they're buying rentals. I just wanted to quickly cut back to this page because they retire with about 100K in the bank, but their annual expenses are almost $600,000. So they would really want way more than 100K in cash. Basically, don't try this at home. And then what we really care about is all the way at the end. Do they have enough cash? Yeah, they actually do have enough cash to cover those end-of-life expenses. So in this scenario, it looks like they are able to swing being able to retire in 10 years just buying base hit deals for rental properties. Let's have a little bit of fun with this then. We're going to assume that Chad and Stacy don't want to live next to their tenants forever. Let's say they want to buy a single family home and it's going to be a nice home, we'll say like $1 million, and let's see if they're able to swing that as well. So scrolling up, we see if they retire at 40, they don't really have enough cash to do that until probably about age 50. So that's 2046. I'm gonna build that goal out here that they are going to move to a single family home. So we're gonna say $1 million in New Jersey. This will be 2046. Annual appreciation, 3%, that's right. Property taxes, this is gonna differ wherever you are. Here in Jersey, we love our property taxes, so 20 grand is pretty normal for a house of this value. Annual insurance will be conservative, say 4 grand, same thing with the maintenance. Now for down payment, they probably have enough in equity from their rentals that they can do a cash out refi on them to purchase this primary home. But we're gonna say they don't want to borrow against the rentals, so they're just gonna use their cash that they have on hand. So we're gonna say they put down 20%, and that way they get around the private mortgage insurance, so 30-year, 6.5%, and their current home they're going to convert to a rental. Now the current unit that they're living in and are going to be moving out of, we're going to say that rents for $21.50 a month. Rent increase is going to be 3% a year. Vacancy rate 5. Depreciation based off their cost basis is going to be somewhere in the ballpark of like 7 grand a year. And then additional annual expense, we don't need to include this because we already have the maintenance expense on the property. So we're gonna go ahead and save this, and let's look at the cash flows. All right, 0% probability of success. That doesn't look good. So going to their net worth page here, they buy a single family home for $1 million at age 50. Yep, we see that they run out of cash and they have to actually take out a HELOC on their properties. This is what this other loan represents in order to make it through it. But like I said, they don't want to borrow against their property. So let's see if we bump that goal back, if that changes anything. So can they do it in 2048? All right, going back over to the net worth tab, and let's scroll down to its age 52 then is when they would make the purchase. The cash is getting a little tight there, but they don't run out of money. Coming back to this page, they have about $200K in the bank, but their annual expenses are $860,000. So that is very leveraged. This is another case of do not try this at home. So it looks like they are, stacking aside money. They're able to float the single family residence, and then their end of life expenses, they're able to comfortably cover those expenses. So can you retire in 10 years from zero with real estate? Yes, it's possible, but it's not easy, and it's definitely not risk-free. In the scenario we just modeled, it works if you're comfortable using a lot of leverage and you're able to consistently find good deals, which is harder than most people think. And one downturn at the wrong time could create some cash flow pressure, and you don't want to wind up like these guys. Now, I've seen people pull this off even faster than 10 years, but those aren't base hit deals. They're finding off-market home runs, often recycling money through cash-out refinances after rehabbing properties. This is commonly known as the BRRRR method, which I didn't use for this scenario, but might make for an interesting video in the future. So if real estate is part of your early retirement plan and you want to see what this looks like for your numbers, feel free to reach out for a free consultation. And if you want more financial planning content focused on real estate, don't forget to subscribe. All right, thanks for watching, and I'll see you next time.